Over the last 100 years, there have only been about 17 bear markets or recessions with an average duration of about 10 months. That tells us when the market does pull back, it typically does not last for long.
So, would you recommend then for investors to keep a little cash pile handy for these opportunities? How are we doing, folks? Welcome to another episode of Stock Club. I'm joined today by a very special guest, Sean Tepper. He's the founder and CEO of Tykr, a platform that helps people buy and sell stocks with confidence. Today, Tykr has over 12,000 customers in over 50 countries, spelt Tykr. Sean, very important. Thank you for joining me today. How are you getting on?
Thanks for the invite. Appreciate it.
So, Sean, we both at my Wall Street at Tykr, we both kind of focus on this retail investor. I think one of the most important stages is that setup phase, getting over those initial roadblocks. So I'd like to start this interview by kind of questioning you from the point perspective of I'm a beginner investor. What advice do you have for me? Is that something you want to get in behind first and foremost, and then
Sure.
we can get into the current market and everything you're doing at Tykr and all the rest?
I was going to say absolutely. And I can give you perspective on my journey from beginner going to, as we phrase it at Ticker, going from beginner to confident investor. Should I start there?
Perfect. That sounds like a great place.
Okay. And so, yeah, my background is about, and I'll keep this about to the 2 or 3 minutes or so, but my background is about 20 years in tech, 15 years investing. I had my first company in the 2000s, just building software and websites for small and mid-sized businesses. Went through a merger in 2010. There wasn't a check written like, hey, here's $1 million, you ride off into the sunset. That was a big lesson learned on building a service business. If you are building a service business, that's totally fine. Do it because you love it, but the exit multiple probably isn't going to be there. That's the reality of the situation. So then I decided to get into investing. However, being a beginner at the time in 2010 or 11, I didn't know where to start. So I joined a broker. I think I joined E-Trade at the time. And then I would just kind of find stocks online, on forums or wherever, or podcasts. And it was kind of like shooting in the dark. And over 5 years, I maybe kept up with the market. And in 2015, I'm like, I have to do something different here. This is just not sustainable for the long term. So I was looking at, and you probably agree with this, is I was looking at Warren Buffett and the late Charlie Munger and realizing that they were able to consistently beat the market. In fact, Warren Buffett has said if he were managing $10 million, he could make 50% per year. I'm like, whoa, that's quite a steep statement compared to the 6 to 8, maybe 10% at best I was making. So you and I both know that these guys are not making decisions based on emotions or feelings, which means they're probably starting with math. And I've got a pretty strong math background. So I'm like, all right, let's reverse engineer the math they use. And I decided to put together an Excel sheet. I went down the YouTube rabbit hole, watch as many YouTube videos as possible. And thanks to a guy by the name of Phil Town, I did find some of the calculus that's used. I put it into Excel, added a little more rigor, and then created a rating system that's really easy to understand, because that was my biggest complaint, and where I think most beginners run into issues as well. Is you can't, like, if you look up any stock, you don't know if it's truly a good stock or bad. You have to go through all this analysis and all your own homework. And I'm like, I need to roll this up to something simple. And that's my background is a lot of process engineering. So GE and Kohler, I give them all the credit. But if you take, like, let's say 100 data points, you have to roll it up to ideally something that's binary, like a yes or no, or a traffic light. And I'm like, the traffic light's the easiest to understand rating system around the world, in my opinion. So stocks in Ticker are either on sale, watch, or overpriced, green, gray, or red. I use that over the next 4 years, making returns between 15 and 50%. Just to make it really easy was my goal, but the returns were kind of like the icing on the cake. And yeah, 2019 was the moment where I'm like, let's share this with a few other people, like regular guys like ourselves, and everybody's like, you need to turn this into software to share with others. So that was the green light to create Ticker. But yeah, it was like a 10-year journey, 5 years to kind of figure out that I'm doing something wrong and I need to do something right. And then it was another 4 to 5 years of testing this Excel sheet with my own money before I even think about handing it to people. So yeah, it took 10 years to really come up with an idea and then execute it into a business from there. So yeah, and you listed the metrics. We've got over 12,000 customers in 50 countries. So that brings us to the present.
That's great, great. And I think what I love about that is you kind of simplified it. At least you simplified a process that works for you. And I think that's where beginner investors struggle, is finding building a foundation for
Yeah.
themselves that works, because it's a very individual process. You build a process that works for you, and like if you have a high risk tolerance, that might mean you have to dip your toe and get involved in whatever gamble is going on at the minute. But in terms of building that foundation for a long and successful investing career, what would be your number one piece of advice?
Education. That's because if you can become educated in the shortest amount of time, you can be confident. And I won't go into too much detail here, but making money, building big returns, or retiring early, all that kind of stuff is a nice to have. A lot of our customers in our community really stress the home run feeling is actually knowing what to buy and sell. Having confidence is everything. So we in Tykr, we do have educational modules. We get a lot of articles. Our email sequence of onboarding gets you up to speed as we phrase it. And you can go from beginner to confident investor in 14 days or less. But yeah, I tell every beginner, you want to be educated. And fortunately, we've got the analytics and education in one clean location. I have other resources I recommend. Phil Town, of course, is great. He's, if you want education, but yeah, start with education. Everything else becomes easier thereafter.
That's great. And you're talking about confidence, probably the most important thing, because that's what will keep you coming back and keep you doing it. If you don't really believe in a
Right.
process, you're never going to stick with it.
Right.
And then on the opposite side of things, then we've kind of said the first thing to do. What's the number one mistake or pitfall you see beginner investors fall into, and how do you avoid that? Because they're cliches for a reason. You know what I mean? People do the same mistakes over and over again in these processes, I suppose.
Yeah, so this is good news for everybody listening is you do not have to be an expert at math. You do not have to be the smartest person in the room. I'm certainly not myself. But you do need to control your emotions. That's where most people go wrong. A good example of this is, let's say you buy a stock and the next day that stock goes down. Well, a lot of people will freak out. They will think they did something wrong. Sky is falling. They're going to lose all their money. And that's the nature of the stock market. You need to look at it like waves in the ocean. They're going up and down at every given moment. You find good stocks off the like right off the bat, then thereafter it's let it go up and down. You're going to keep investing over time if that business still has really strong financials. And if you can train the discipline of not worrying about the ups and downs daily and weekly or monthly, you will do very well. And I've got tons of case studies of people who have very low salaries who have built up multi-million dollar portfolios because they can control their emotions. They don't worry about what's going on day to day.
Yeah, there's that famous story from the Morgan Housel book, "Psychology of Money." I think it was he a janitor at college, and he built up an $8 million
You,
fortune
Ronald
in
Reed. I
exactly,
share
exactly.
that story with everybody. It's the Ronald. He held about 10 to 15 blue chip stocks through the 70s, 80s, and 90s. Of course, no financial advice here, but I think it was like Johnson and Johnson, GE was in there, Dow Chemical, Walgreens. Anyway, it's like he's going into a select group of stocks and he's going to make his first million and then build up $8 million thereafter. Warren Buffett, and listeners, if you don't know this, Warren Buffett, yeah, Berkshire has 40 businesses today, give or take. However, he built his first million investing in about 10 businesses. You want to build your wealth, you have to be focused, find strong businesses, and keep investing over time.
Okay, and I have this next question worded in as basic language as I could come up with,
Mm-hmm.
because I think there's a purpose behind that. And the question I'm going to ask you is, how do you find good stocks?
Yes. So if you don't want to use Tykr, I'll give a quick pro tip here. But thanks to all the training from Phil Town, Warren Buffett, and Charlie Munger, there's really 8 lines on the financial statements you'll pay attention to. I won't go into too much detail here, but on the income statement, you've got revenue, net income, and EPS. On the cash flow statement, you have free cash flow. And then on the balance sheet, you have assets, liabilities, debts, and equity. And what you want to do is you want to look at the last 4 to 5 years and make sure the numbers 6 of those 8 numbers are increasing quarter over quarter. And if you can look at it, you can just eyeball it and quickly determine in about 60 seconds or less if it's a strong stock. Liabilities and debts you want to see going down, but everything else I mentioned you want to see moving up and to the right. So a good example is, let's say you've got a company that the revenue was, I'll use nice round numbers. It was a million. It was a million 5 years ago. 4 years ago was 1.25. 3 years ago, 1.5. 2 years ago, 1.75. And now the recent year is 2 million. So those numbers are increasing. That's a good sign. And that's pretty easy to visualize. Of course, if you want this gamified and made easy, Tykr has all the ratings, but that's how you determine if a stock is stronger or weak. And I'll give one more example here. We at Tykr, we collect a lot of data to pull, like raw financial data. And with that, we don't always have the newest IPO stocks because you need historical data to make a correct analysis. Well, Figma went public recently. They're all the rage. People piling into the stock. And Yahoo Finance ended up getting the data a little earlier than us, and they've got a different data source. But I showed the Tykr community, hey, let's go manually look at this stock, and we could quickly see the net income and EPS were drastically decreasing. However, everybody's piling into stock, and people don't know this. The number one most important line on the financial statements is EPS. In most cases, not all, but earnings per share is just net income divided by outstanding shares. If that number is increasing and you beat your earnings report, in most cases, share price goes up. Of course, as your profits or EPS is decreasing and you miss your earnings report, most cases, share price goes down. I'm like, guys, the rug is going to be pulled out on Figma here. And sure enough, it
Yeah.
did. Doesn't mean it's a bad company. We use Figma at Tykr, but would I invest in Figma right now? No.
Yeah.
We want to
We
wait longer.
we
Yeah.
used to have a golden rule at my Wall Street. You couldn't. This is back when my Wall Street was much more expansive platform and everything. We couldn't
Sure.
select a stock within 6 months of IPO.
Yes.
That was the no go zone. And
Yes.
yeah, Figma is a great example.
Phil Town teaches 1 year. We actually tell people try to watch every quarter, but it's going to take 4 quarters or more for that business to get into a strong financial state anyway. So your 6 month rule is spot on. Yeah,
Yeah,
good call.
yeah. So then this is a Tykr specific question now. So I've been
Hmm.
doing some research, and you say there are 4 types of stocks you can invest in. Could you break that down for me?
Yeah, so you have value stocks, you have growth stocks, speculative stocks, and dividend stocks. So kind of break those down. So value stocks, that's what Tykr's all about. We're not traders, we're investors. We got an article that teaches the difference there in our onboarding. So that's number one. Those are value stocks are essentially financially strong businesses. All those numbers are moving up and to the right. We care about the fundamentals. We do not care about charts and graphs or anything that's trading focused. So value, again, strong financials. Now, then you get to growth stocks. I'll give you a framework here, and thanks to Phil Town and Warren Buffett, it's called the 4 M's of investing. We actually gamified this and put a patent on it in Tykr, but here are the 4 M's. So you get the math part, that's the financial strength of the business. You get the meaning, that's how the business makes money. How many revenue streams does the business have, and how scalable are those revenue streams? The third M is the moat, how it compares to other businesses in the same sector and industry. And then you have the management, that's the track record of the CEO. So typically a value stock will check all 4 boxes, all 4 M's. Now with growth stocks, that first M may not be strong. The financials might not be there, but the other 3 M's, that meaning, moat, and management, those boxes could be checked. Doesn't mean it's a bad business, just be careful, it can be a little more volatile. So we at Tykr, we do tell people lean towards value, but if you find growth, that's okay. Just prepare for a roller coaster ride. The third category would be speculative. And in that case, those stocks are primarily overpriced in Tykr. And that's the great majority of stocks in the market. Most people
I
don't
was
know
going to
that.
say it's a very topical moment right now for those speculative stocks.
That's most businesses, they're businesses, but they just don't have the strongest financials. And unfortunately, most people holding ETFs, index funds, and mutual funds, if you ever take a look at your funds in Tykr, not all, but a lot of them, they're either watch or overpriced the entire fund because the majority of the assets, the majority of the stocks within are overpriced. And that's why I tell people you're not getting big returns because all those stocks, they're holding you back. You want to be Warren Buffett, invest in individual stocks. Of course, retirement age, you can move to funds, but you're protecting your money. So anyway, speculative, primarily you're not passing any of the M's. And then dividend stocks are kind of in their own category because a dividend stock can also be a value stock. Essentially, if a business has strong financials and they can pay you and I a dividend for simply holding the stock, that's a good place to be. But I tell people this, and this is in the training, you're not going to build your wealth even close to as fast as value stocks because the returns of compound interest are significantly greater. Unfortunately, I see too many people in like their 20s and 30s, maybe in 40s, like, all right, I'm going all in on dividend stocks. I'm gonna get rich. It's like, yeah, you'll get rich in 30 years with dividend stocks, but we tell people try to build your wealth with value investing. And when you get within 5 years or less of retirement, then consider moving to funds like ETFs and index funds, or go into dividend stocks. And we get a few financial advisors. They do exactly that with our customers. They're like, yeah, we're just transitioning from value stocks to dividend stocks. And that way, in retirement, hopefully you've got your home paid off and other things paid off, but you can just pay yourself a dividend to enjoy the hobbies you want to enjoy. So you don't have to sell any shares of businesses. So anyway, a lot of cover there, but those are the four types of stocks in the market.
Ideally, your value and growth stocks would eventually turn into dividend stocks by the time you retire if you hold for that long and they
Correct.
turn out to be that successful. You sparked an idea, and I asked this question to a lot of people that come on the podcast. In your view, what's the difference between, and this is specifically in the stock market, specifically for stock pickers, what's the difference between wealth creation and wealth preservation?
Yeah, so that relates to the strategy, and we phrase it a little different, but it's very much in line where you're going, which is wealth building mode and wealth protection mode. So you've
Yeah.
got wealth creation and wealth protection. When you're still working and you have a timeline to retire, and we have this all broken down mathematically, so it's super easy for people to understand. So if you have a timeline to retire that's 5 years out or more, then you want to be leaning towards individual stocks, getting those higher returns. Now, we do not guarantee it, but we tell people if you're finding strong stocks and have a focused portfolio of about 10 to 15 stocks, you should be getting returns. Again, no guarantees, but your returns should range between 15 and 50%. In Tykr, we are seeing the returns, and we're going to show this to everybody. This is an analytics feature, but it shows our customers on average, they typically get between 15 and 20% per year over the last 5 years, over the age of Tykr. That's great because compound interest, and here's some nice math for you, and then we'll jump to wealth protection mode here in a second. But we're starting a club called the $100 a week club. And I'm going to ask you a question here and see how close you get. But if you invest $100 a week in 17 years, what do you think that will equate to? What number do you think? Just $100 a week at earning over 15%. What will that equate to?
Earning over 15%. Oh, wow. So what's that? We've got 5 grand a year. So we've got 75 grand going in. And then you will earn at 15% is a lot. If it doubles every 4 years, it doubles every 5 years, it doubles every 7 years at 10. Is that correct? So,
Yep.
do my maths here. 200 grand.
You're, I like the math there. And to do it in your head, I'd give you credit. You'd be Rain Man if you could pull that off. But yeah, the number is if you start, and I left out one metric, but if you start one of the account size of 5,000 and then do the $100, it'd be 1.1 million in
Oh,
17
wow.
years. Yep, and then 2 million in 20 years. So it's like when people will hear that, they're like, "Oh, that's not a lot of money. What if I could do more than 100? Then do more
Yeah.
than 100, right?" So people need to be focused on the discipline, like we talked about Ronald Reed. Is he didn't have a big income, but he had the discipline to never skip a month. That's the issue, or one issue I talk to brokers right now about their customers, retail investors, is they will join a broker and they will wait 3 months or 6 months or 9 months, and I'm gonna sit on the sidelines. I'm just gonna read some more and then see what's going on. It's like, no, 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 you can't do that. You got to be in the game. So that's why we shorten that timeline to learn. So that's the wealth creation mode, as you phrase it, or wealth building mode, as we phrase it. Wealth preservation is that's when your timeline is the 5 years or less. And we talked about that. You can move to funds. You should not expect big returns at that point. It's just protecting your wealth, or you move to dividend paying stocks. So I'll tell you right now what my play will be dividend stocks. So I keep the stocks I hold. I don't have to sell shares, but I simply get paid a dividend.
Yeah, yeah. I think that's very that goes along with the ability to keep doing the same thing over and over again. I think Warren Buffett said investing is not easy, but it is simple. It's a very
Yeah.
simple process, but you need to find the process that works for you and that will help you sleep at night and that you can do consistently every month, every week, whatever it is, whatever that time period is that you put in money. Because I noticed it even myself, like as in I'm here on this podcast telling people what to do, and sometimes I want to sit out for a month because the market seems frothy or I don't have any good ideas or whatever else it is, you know. And like I feel like with that, certain stocks can really help. A stock like a Berkshire Hathaway, or I
Mm-hmm.
always quote it's a Swedish company, Investor AB, where
Yeah.
it's not really a stock. It's a collection of 100 or 200 or 300 businesses that if you have no better ideas, okay, well, I'm very confident my money is in safe hands here. I trust the CEOs. The CEOs are essentially investors. They're not particularly running the operations of the business. They're just putting their money to work, and they're not going to put it into a bad investment. You don't get to
Right.
be Warren Buffett obviously is going out the door next year, but Greg Abel, he's going to be the heir
Mm-hmm.
apparent for Berkshire Hathaway. He's not going to get that position without being a good investor. That's
Right.
what it comes down to. These kind of companies that act as they take the weight of responsibility somewhat of managing the money off your hands. Do you know what I mean? I'll just
Yep.
give it to a more trusted, qualified investor than myself to go and spend that in the right way. So that's one piece of advice I would like to say in terms of don't get caught sitting on your hands. So it's kind of what you're saying as well. To have that kind of backup plan in
Mm-hmm.
terms of a good, safe blue chip asset you're happy to put in money month after month and not worry about a position building up too much
Yeah.
compared to, say, I would be very nervous if I had a very large position in quantum computing stocks or something like that, where it's incredibly speculative right now. It's okay to maybe dip the toe and have a little small punt if it works out. Owning just a little piece is enough, but to have a lot of money invested in those kind of speculative assets, it would affect the sleep, And all we're trying to do, I think, is
Yeah.
sleep tight at night, knowing we're building a wealth for our
Yep.
future selves. So,
Yeah.
yeah, in terms of avoiding sitting on the hands, would you have any more advice to add to that, or?
Yeah, I would say it's not like you have to spend hours, if not days, of research. Fortunately, as we phrase it, 15 minutes a week. And Phil Towns says the same thing, 15 minutes a week. That's one thing where people are like, and I run into people all the time like, oh, you do individual stocks? I don't have time for that, so I'm just going to the S&P 500. Or I don't have time for that, I'm just going into a mutual fund. It's like, no, no, no. Like this literally our platform, not to oversell the thing, but it's like 15 minutes a week. But again, Phil Towns teaching, he does the same thing in his process, a little more manual. Tykr is a bit more advanced, but he's right in line. Like you want to be about 15 minutes a week. It's like I think everybody can carve out 15 minutes a week to become a multimillionaire in the not too distant future. I think most people would be, oh, okay, that trade off I could align with. So there's a lot of myths, and we could probably talk for hours on the myths of investing. And that's just one of those. Like you don't need a lot of time.
Yeah, yeah. Okay, so talk to me about Tykr. You set it up in 2020. That's correct.
Yeah, we went live in 20. Yep.
Yeah. So that's been like the busiest 5 years of the market in terms of, we've seen a market crash, we've seen a bear market, we've seen the whole GameStop saga. Interest rates went from 3% to 0 to 5% in no time at all. And despite everything, the S&P 500 it's more or less doubled in that time period.
Yeah.
And we're back sitting at all time highs today. So how has that journey been at Tykr? Because I imagine you've had a bit of a roller coaster, to put it mildly.
Well, this is a key strategy, and I have to give Phil Town the credit on this one. And then Warren Buffett is one of my favorite quotes from him is you want to be greedy when the market is fearful and fearful when the market is greedy. Well, fortunately, as we teach at Tykr, you actually want pullbacks because that's where you make the biggest returns. We're not shorting stocks, but what it is if you find financially strong stocks and the market pulls back, that's when you need to strike, when the iron's hot. So for transparency, 2000 and what was that? 20, that was my best returns ever because the market went down because of COVID. Nothing we can control as investors. And I knew based on the training, when you find financially strong businesses and the market pulls them down, there's nothing wrong with the businesses, but the market pulls them down. The market went down 30%. Well, that year, my returns were over 120. Will I make 120% every year? Absolutely not. But when the market goes down, you want to use that opportunity. So we train, I say, our platform and then my teachings. You want to keep buying every month, DCA. But then when the market pulls back, like it did in 20, and then it was, what was that? 2021, it was November through about March of 23, it was almost a year and a half. There was the triple threat. It was like the Omicron variant of COVID. It was the rumors of Russia invading Ukraine. And then there were rising interest rates. That triple threat moved us into recession. Some people were like, it wasn't a recession, but it's like, hey, what was it? 2 consecutive quarters or more is technically a recession. We were there. That was another stockpiling opportunity. When Trump started the whole tariff negotiations again, there was initial pullback there. And I told our audience, get that free cash ready, deploy it. You're going to make the bigger returns. And it's really just rinse and repeat. So now the Tykr communities, you become more educated. You realize like when things are good, I mean, that's all right. But you want things to go south because that's when you make the big returns. And I'll say one more thing here. And we teach people this is over the last 100 years, there have only been about 17 bear markets or recessions with an average duration of about 10 months. That tells us when the market does pull back, it typically does not last for long.
So, would you recommend then for investors to keep a little cash pile handy for these opportunities?
Yeah. So what we teach people is whatever your paycheck is, we'll use some nice round numbers here. Let's say you put $1,000 into your broker per month. Doesn't mean you invest $1,000. What we tell people is 50% should be DCA, dollar cost average, 50% DCA and 50% kept in cash. The reason I like to keep my cash in the broker is there are times when you move money. Let's say you get a big pullback today and you got to move money from your bank to your broker. Sometimes it's instantaneous, but other times it can take a few days.
Oh
And
yeah,
that
for sure.
and the right, the market can go back up and you miss your opportunity. So you want that free cash sitting as close to the stocks as possible. So that's what we tell people: 50% DCA, 50% stockpile, it's called. And then when the market pulls back, you've got all this cash ready because you're going to make your biggest returns. And there are, thanks to Phil Town and these case studies, if you get 1 or 2 stockpiling events in your life, like a big one, like I knew a plumber in '08 that took 100 grand and turned it into 2.5 million in about a year and a half. The reason he went into Ford, because they're the only company that did not take the bailout because they had a strong enough balance sheet. He was listening to Warren Buffett's teachings. And he admits today going all in on one stock was pretty speculative, but he was following the logic. But yeah, he was done working in his younger 30s because of one stockpiling event. That was it. 100 grand into 2.5 million.
Yeah, yeah. So, talk to me then about the current market where we're seeing very different sentiments, I suppose is the way of wording that. We've got pre-revenue stocks at $20 billion valuations. We've got short squeezes like Open Door. Companies are
Mm-hmm.
adding trillions of dollars to their market caps in the space of a few months, and even private companies like OpenAI are having huge influence on stocks.
Yeah.
Big stocks like Oracle, AMD. All of this is happening. It to me personally feels quite frothy, and there's almost an acceptance of, oh, we're in a bubble, but is it
Uh,
1996 or is it 1999? What are your thoughts on the current market?
No fears right now, to be honest. I think the market's going to continue the way it is. Based on, again, those last 100 years and 17 bear markets, if we see little blips, there's got to be a reason for it. So we got desensitized to the Trump tariff wars. We saw what I have a blog post on this. There was Trump tariff war one, which was between 2017 and 18, and then
Mm.
two was this last year. Like if he says anything about tariffs again, the market's going to keep rising. It's not going to pull back. So that's not it. Um, Inflation is at a good spot. What in the US, we're at like, I think 2.95. I checked yesterday, and if you can be between 2 and 3, that's really good. So inflation's where it's at. Interest rates on homes are coming down. I think it's like 6 point something. It's not ideal, but it's moving in the right direction. All the levers being pulled in the right direction. Like we're in a really good spot. Now with businesses, you make a good point. There are businesses that are speculative. They're taking off like a rocket. Fortunately, and this is why I created Tykr, is I needed to cut through the clutter so I don't buy these highly speculative businesses that sure they can make me a ton of money in the short term, but they're just too risky for the long term. So as long as I'm using Tykr, I know my portfolio is going to continue doing very well. Like right now, even if people are calling it frothy, and there are news outlets in the States that will say every year they've literally said this since 2008 that this is the year there's going to be a crash. This is the year
Yeah,
there's going to
yeah.
be a crash. This is, I think you know what news outlet I'm talking about, but
Well, it's across the board. You know, they've predicted 11 of the last three recessions. I think is the term a lot of people throw around. You
yeah.
know.
Yeah, and that's why the sound strategy of keep investing 50%. Ronald Reed, he never skipped a month. Keep investing. Again, janitor, $8 million. He was doing something right, and then to level up on top of what he's doing, take it to another level, which is the stockpiling. If the market crashes, my response, good. I
Yeah.
hope it goes down harder and further than it ever has before. Because guess what? The businesses I invest in, they're they're run by solid CEOs, and they're going to say, "Yep, business as usual. We're going to keep doubling down." And I won't go into too much detail here. I've worked for a lot of large organizations, and when you get into the C-suite, you pull back the curtain, you understand the conversations that are being had during tough times, and these C-level executives are not using language that's, you know what, times are tough. We need to slow down sales. Times are tough. We need to take our foot off the gas. That kind of attitude is not in the C suite. These people are running businesses. They got to that level because they're making the tough decisions. And I've been in those rooms when they're like, guess what? Market's going down. If our competition is fearful, guess what we're going to do? We're going to double down because we're going to get through this. And I'm like, we as investors, we need to adopt the same fearless mentality. Think like an executive and you'll do even better.
Mm. And it's great saying that, and it's a lot easier to say that in good times. But when you're in the thick of those bad times, to it's tough to act in the way you know you should,
Yeah.
because you're seeing a bunch of red arrows going down on CNBC and all the rest, and it just feels like, how do you filter out the noise? And I suppose it goes both ways, because there's probably noise on the upside as well. Right now, we're talking about how many media outlets are calling it frothy and bubbly and all the
Mm-hmm.
rest.
Yeah.
How would you give advice to people to just filter out noise and concentrate on their strategy, whether it be good times or bad times?
Yeah. Another quote, I'm going to slaughter this one here, but Warren Buffett has talked about, hey, if he were to pick a stock and that stock were to, like all the charts, all the information would be removed for the next 10 years, he does not care because he's focused on that long term of a situation where you buy the businesses, and if that share price goes up and down like sawtooth action, don't even worry about it. What I look at, and this is the thing I remind people, is don't worry about the charts, don't worry about the news. It's good to listen to it to just get perspective, but I know the businesses that I invest in, if those financials, again, it all cuts back to looking at tickers. If you got revenue that continues to increase in good or bad times, that's great. If the profits are the same behavior, that's great. If the free cash flow is the same behavior, it's like you've found yourself a resilient and anti-fragile business that can power through good times and bad. Those are the businesses I will always invest in. And over a decade now, consistently beating the market, it's that same behavior as finding those usually non-sexy businesses, but they're just run by good people and they have really good products and services. They're going to withstand the tougher times. And again, going back to the average duration, 10 months, like you can survive 10 months of
Yeah,
downturn, right?
yeah. Okay, that's great. We're going to finish up soon, Sean, but I can't let you leave the show. I get it off every we get it off every guest that comes on. We're going to have to get some tickers out of you. So all our guests get asked this question: what are some of your favorite investments right now?
Yeah, and you probably got all the disclaimers, not financial advice, but I really do like Palantir. That has been one of my top performing. It's the model of the you've got the tech, and I won't go into too much detail, but my background 20 years in tech, especially enterprise, I get how this works is you've got that tech layer, but then you have a consulting team that goes with it that implements. And if you have customers that are complaining or they want changes or this or that, you have a group of people on the front line that can make adjustments right there, and that creates a stickier product offering because, as you know, if you offer a software to people but you don't put people with it to help maintain it, there's a high probability of churn. Well, Palantir, there's other tech companies that do the same thing. You want to couple product with service, and then, as we know, they're locking in some huge government contracts and public sector contracts, or
Yeah.
private sector, I should say. Second favorite is Nvidia. I microchip, semiconductors are in everything. Refrigerators, cars, microwaves, cell phones, computers, everything. It's like those will never go away, and they happen to have the fastest chips on the market. So data centers, they've owned that space. The more AI is used, the more data center load we put into place, and we need chips that are the best of the best. Well, Nvidia happens to be there. So that's number two. Number three has not been my best performing, but they do double the market, which is Microsoft. Microsoft has the most revenue streams out of any business I know, or one of the most. I know Alphabet's pretty close, but you look at Office, you look at Dynamics 365, you look at Windows operating system, Xbox, Activision, the list goes on. It's like like if I'm an entrepreneur, which I am, and I'm building a business, I want multiple streams of revenue because if one slows down, the rest can keep it propped up. And Microsoft is that to the nth degree.
Brilliant. Strong threesome there. I hope you got in early on them. Would you have any concern about valuation, especially in Palantir's case?
None. Their financials are incredible in Tykr. As long as they continue to increase those profits, they're going to have financial institutions keep piling in. And you look at what they're doing in the world, we know, though, and this is not a pretty world we live in, but there are conflicts all around the world. And Palantir, they do serve military organizations here in the US as well as the allies around the world. And you hate to say it, but it is benefiting off of the conflicts. It of course there's an emphasis on defense and getting ahead of conflicts, which I really appreciate by Palantir. But yeah, I wouldn't see Palantir. Some people are like, that's a meme stock, it's going away. It's like the world we live in, it's not rainbows and butterflies. Like this is a tough place to live, and we got to be on our guard. And thankfully Palantir is on the front line with its tech.
Okay, brilliant. Well, Sean, tell people where they can find you if you want to give one last plug to Ticker there, and we'll say goodbye.
Yeah, keep it simple. Two places. Go to Tykr, Tykr.com. You can join Tykr for free. And then I'm really active on LinkedIn. Sean Tepper. Sean is spelled the Sean Connery way.
Our listeners will know how to spell Sean, anyways, if they know anything. Sean, thank you very much for joining me, and thank you everyone for listening in today. It was a great interview, Sean. So, very good luck with all the rest of Ticker, and yeah, I'm kind of jealous of your top three stocks there. Getting into early for Palantir and Nvidia is kind of making me a bit green. But that's all for this week. We will talk to you next week. Thank you for coming on.
Thank you.